Ryan, we were, just talking about the speech that's making waves, continues to make waves in markets right now. Wondering how you parse through the Fed chairman's reaction. We've essentially seen the S&P 500 reverse to levels that we saw prior to the July FOMC meeting. Have the conditions tightened to the point that the Fed would have liked to see after that big speech on Friday?
Yeah, well, listen, everyone said, oh, he's going to be hawkish. He's going to be hawkish. And then he was, and it seemed like it tripped the stock market up. But what caught us at Carson Group on the investment team when we looked at it, look at 10-year yields on Friday. Like, they didn't really move. Look at expectations for a 75 basis point hike. They're up a little bit, like you said, like over 60%, not that much. So it's really unique, just the reaction, how it caught some people off guard and not others. But the bottom line, you guys summed it up perfectly, I think. The bottom line, he got tired of hearing, oh, there's a dovish pivot coming, right? Look at inflation. One good month of inflation. That's all it's going to take. He said, listen, I'm going to take 8 minutes, and I'm going to fix this. I'm going to say, we're staying hawkish. We're keeping rates higher longer than probably you think. And that's just how it is, because we are going to break inflation's back.
Ryan, no question that we saw a shift in sentiment on Friday on the back of that speech. But how much of the swings that we actually saw had to do with where we are in August, which is, sort of typically a lighter trading period? I mean, how much of what we saw was magnified because of that?
Yeah, that is a great point. Something we've been talking about. I mean, you guys, so we had a 1,000-point drop right on Friday on the Dow. We all know on percentage basis, it's all relative. Still, a 3% drop's a 3% drop. The first 1,000-point drop ever was like August of 2015. All these August, for whatever reason, has some really big swings. And then don't forget, September is right around the corner, right? September is the worst month the last 10 years, the worst month the last 20 years, the worst month since 1950. So the thing we're saying is, hey, after 17.4% bounce off those June 16th lows, right into the 200-day moving average, perfect place to maybe catch your breath. Now we're getting that downside volatility. We do think the lows for the year are in. We can maybe talk a little bit more about that if you want. But the truth is the calendar is doing no one any favors, and the Fed now added some more uncertainty. But it just made sense. This is kind of where volatility tends to happen for whatever reason. It just happens in August and September.
So, Ryan, I guess on that point, then, how do you kind of approach this market from a strategy standpoint? Because the volatility is essentially returned, right? Because a lot of people were expecting after maybe the June and July meetings that, all right, they had more certainty about what the Fed's going to do. And what they've said is it's data dependent, right? So do you just stay on the sidelines now, or do you make some aggressive moves into equities knowing that maybe this is actually going to be the last drop that you can get in on?
Yeah, we think it's closer to the last drop you can get in on. I mean, we're overweight equities here at Carson Group with our investment team. We think, after one of the worst starts here ever, we understand that. But off those June 16th lows, what have we seen, right? We've actually seen some pretty strong market breadth. I don't want to get too geeky on you, but there's something called the advanced decline line, how many stocks going up versus down. We just made a new all-time high on that for the S&P 500 2 weeks ago. Historically speaking, that's a good sign because market breadth leads overall price, and that potentially means, hey, stocks can continue to be pretty strong the second half of this year, or at least the remainder of this year. And let's not forget again, we talked about August, September. We're in a midterm year. Historically, midterm years are literally like the weakest out of the 4-year presidential cycle, with a 17% peak to trough correction on average. A year off those lows, though, you're up every single time of over 30% on average. And the fourth quarter of a midterm year is usually really strong. So again, nothing's perfect. There's all these uncertain things that are out there. We get all that. But the weakness the first 3 quarters of this year is kind of playing in what you see after a 120% rally like we had off those lows, that, we'd still be buyers of any potential weakness of equities here. We think stocks will do a lot better than bonds the rest of this year.
So, Ryan, let's talk specifically about what you like in equities. You mentioned small caps, but also energy. What specific names or parts of the energy sector do you like right now? I mean, things have started to pull back if we're talking about oil, but there's still a lot of uncertainty, especially with what's happening abroad, whether that's the Iran nuclear deal, Russia, Ukraine, and then obviously the knock-on effect that it's having in Europe.
Yeah, you're right. I mean, I can't give any specific names, but like XLE, right? Just the energy group in general. The relative strength just made like another new high here versus the S&P 500. That's where the strength is. And we've seen the big pullback in energy prices and crude oil, but look at natural gas, right? Natty gas is still strong because of some of those things you talked about going on in Eastern Europe. So energy still makes up like less than 5% of the S&P 500. It was even lower this time 2 years ago. By the way, 2 years ago is when Exxon got kicked out of the Dow. Remember that? I mean, that was like a major major contrarian buy signal if you look back in history. But again, so energy is a smaller part, but just the fact small caps, like last week, right? The S&P is down over 4%. Small caps did better. We're starting to see small cap strength. What in the world does that mean? Well, maybe it's a sign of some positive strength under the surface, because again, there's a lot more small caps than there are large caps, and small caps are more domestic by nature. So we get all the worries that are out there, but this little bit of small cap strength, and small caps are historically cheap relative to large caps if you look back the last couple decades. So, small caps, energy are two groups we like. Also, industrials are starting to show some real good relative strength. Again, more of a pro-cyclical name, if you will, cyclical area. We think industrials are good. Then on the other side, like a barbelled approach, the utilities, they're more defensive, but hey, they've been pretty strong too. So we've kind of got a barbelled approach here with some of these groups that don't always rhyme, but they are leading here.
Ryan, I love the enthusiasm there. I got to ask lastly here, just in terms of the bonds versus equity story here. I mean, you mentioned that bond markets didn't really move all that much after Jay Powell's speech on Friday, but maybe that's because they had been repricing before the stock market was. When you take a look at the bond yield rip higher, actually kind of began at the beginning of the month, whereas the stock market didn't really start to reprice until essentially 2 weeks ago. So what does that lag tell you? Are bond markets getting the message clearly, more clearly than the equities market does? And what does that tell you about maybe where your money should be going?
Yeah, well, maybe they say, bond markets is smart money, and maybe you just pointed that out where they were kind of sniffing it out beforehand. So I think that's true. But, we're talking about the bond market and yields and, inverted yield curves, but still look at the credit markets, right? Look at spreads, high yield spreads, investment grade corporate spreads. They're by no means blowing out like we've seen before major catastrophes or even major recessions, to be honest. I mean, we've created over 3.3 million jobs this year. You don't have recessions when you're creating jobs like that. So again, the credit markets are still pretty calm. The volatility is there in the bond market and the stock market. It's probably going to stick around for a while, but the credit markets are saying, you know what, we don't see a monster under the bed, and any continued near-term weakness could still be an opportunity for at least equity investors here.